Is the efficient market hypothesis still relevant for market analysis? Imagine trying to beat the stock market by finding undervalued stocks or timing the perfect entry and exit points. It sounds tempting, but how realistic is it? That's where the efficient market hypothesis comes into play. This idea suggests that all available information is already reflected in asset prices, making it nearly impossible to consistently outperform the market through analysis. Developed in the 1960s, the hypothesis states that markets are efficient in processing information. So, whether you look at technical charts or analyze company fundamentals, you're unlikely to find an edge that others haven't already factored in. This is why many investors prefer passive strategies like index funds and exchange-traded funds. These aim to match market returns rather than beat them, which aligns well with long-term financial planning. In the world of specialized wealth strategies, understanding this helps shape realistic expectations. For example, when building a diversified portfolio, it's better to focus on spreading risk and minimizing costs rather than trying to pick the next big winner. This approach is especially useful in liquid markets like stocks, where information flows quickly and efficiently. But the story isn't the same everywhere. In real estate, for instance, the hypothesis doesn't hold up as well. Properties are unique, transactions are less frequent, and information doesn't spread as fast. These factors can create inefficiencies, making it possible to find opportunities that aren't immediately priced in. Market anomalies and behavioral finance studies also challenge the idea that prices always reflected all information. Sometimes, investor emotions and biases cause prices to deviate from true value, at least temporarily. Still, even supporters of the hypothesis agree it's a model, a useful one but not perfect. It reminds investors that trying to beat the market consistently is tough and that a disciplined, diversified approach is often best. For investment strategies, this means focusing on long-term growth and risk management rather than trying to outsmart the market. It encourages using low-cost, broad market funds and avoiding frequent trading that can eat into returns. In the end, the efficient market hypothesis remains relevant because it guides how we think about market behavior. It helps set realistic goals and supports strategies that prioritize steady growth and risk control. While it's not a perfect rule, it's a helpful tool in understanding the landscape of market analysis and making smarter financial decisions.